Let's get the big picture now and connect all the dots with Michael Vogelzang. He's president and chief investment officer of Boston Advisors, where he oversees $1.8 billion in assets. And Michael, one of the interesting things about your fund, the Broad Allocation Fund, is that you buy pretty much everything. So you're the guy who can connect the dots for us here. Where's their value and where are you staying far away from?
Well, there's a few things we don't buy, but we do call it broad allocation for a reason. We are more constructive on some agricultural commodities. We're getting a little more interested in energy, although we're still underweight. Interestingly, the place we're the most constructive is in the U.S. equity market. We're a bit overweight there, although we're significantly underweight developed non-U.S. equity and emerging market equity. So, we still think we're in a bear market from an equity perspective, and this is just more volatility on the upside this week. But until we break out clearly above this trading range that we've been in since the waterfall event a month or so ago, we're going to remain pretty skeptical until proven wrong.
Michael, how much of your investment thesis at this point, or your investment outlook at this point, hinges upon what happens in Europe?
Well, a lot. We think the basic view of particularly the U.S. equity market and sort of by extension the rest of the global equity markets centers around whether or not we're going to tip into a recession. The stock market, of course, forecasts 3 out of the last 15 recessions, or 15 out of the last 3 recessions rather. So there's a lot of false positives in this market saying that the recession's coming. So we're not sure that there's a recession. We think it's probably unlikely. But the key there is if we have a recession in Europe, or if Europe continues to get worse, it may very well drag us in the United States here into a recession.
Right.
And we think then we've got some more downside in the market.
And so far it seems as if the European leaders are suggesting that there's no threat of a recession at this point, but they've also been pretty clear today that fiscal stimulus is not part of their plan. It's going to be about austerity. Do you think that there's a high likelihood of recession given the austerity measures and given how weak the economies throughout that region are at the moment?
Well, Lisa, what are they going to say? Yeah, we expect to see a recession coming on? No, of course not. They're going to say that things are pretty good. They're going to say that that they're going to be able to skirt around this. The fact of the matter is, if they don't have stimulus, if they don't have a concerted monetary policy, although there's some modest positive discussion going there, if they don't have anything really solid to fight the recession, and all they're going to do is go with austerity, you're going to see a slowdown in the economic growth. And we fully expect that will slip Europe into a recession. The question then becomes, does the EM strength, does the growth in the emerging markets continue to propel the rest of the globe and keep the United States out of a recession? If that's the case, then I think the market's probably seen its bottom. If it's not, we'll probably head lower.
Hey, Michael, that's a key point, whether or not the emerging market can sustain us. The key there is commodity demand. Copper was down today, oil was down today, and yet gold and silver are up. Does that give you cause for pause?
Well, we've actually lightened up our gold position. Gold's acting very strangely, certainly not as consistent as it had been. We've cut our gold position more than in half over the last month. So we're a little bit mostly on price and sentiment, and everybody had to get gold, and so we decided to sell some. We are actually a little more constructive on the agricultural commodities, not so much on the industrial metals, but the agricultural commodities. We've recently added to cotton. We've recently added to corn. And we have some other broad baskets of general commodities. So we are more constructive there than we've been. And again, the price of oil at around $80 or wherever it happens to be this afternoon feels pretty good to us, certainly better than 115 where it was earlier this year.
Mike, I want to bring Sheila Dharmarajan in. She's been taking a closer look at the emerging markets. Hey, Sheila.
Hey there, Lisa, and hey there, Michael. I wanted to swing back to that point about emerging markets because there certainly is a growing controversy around those BRIC countries. On the one hand, stock markets certainly haven't performed that well. They've had to deal with rising inflation. But on the other hand, you take a look at the demand picture and some of the fundamental demographic pictures. It's still a very, very strong economy and economies. And then also you're starting to see signs that folks are cutting rates. Brazil and Russia, for example. What's the catalyst for you in emerging markets? I know you're underweight them now. What's going to get you over the fence?
It's a good question. I think, I think probably a better tape in the stock markets. I mean, right now, if you see what's happening, there's money coming out of EM, has been now for about 7 or 8 weeks consistently. I think it's still a risk-on trade, and right now the world's looking for risk-off. And so until we get a turn there, I think we'll be pretty cautious and pretty patient. Again, we're not terribly negative. We love the long-term secular story in emerging markets, as do, of course, many people. But we've been overweight for the last 2 or 3 years at least in emerging markets, and so it's been fairly recently that we've cut back. So, we love the story. We think it's certainly long-term secular growth is going to be far surpassing the developed world. The question is timing, and I think we've got a little time yet. I think there's still going to more money is going to be coming out of there before it starts to go back in.
Mike, let's take a closer look once again at the U.S. stock market. A lot of single PE stocks out there at the moment. We have seen some estimates coming lower for now, but any value that you see out there at this point?
There's a fair amount of value. I think it's the old question: is it a value or is it a value trap? And I think look, this is a very challenging market. Let's be very clear. There's no direction. Cross correlations of individual equity holdings are extremely high. The correlations between sectors are extremely high. There's different leadership. It feels like every other day. It's a very hard market to get any real traction in as an investor. So, we're looking at this as a what's the right way to say this? It's sort of a barbell approach. We're looking at some of the deep value, the sort of anti-momentum stuff. To put a couple of names on it, things like Hewlett-Packard, or not RIM, but maybe a Nokia, or things that are really deeply out of favor, that are trading at 5, 6, and 7 times earnings as sort of a half of a portfolio. And the other half, we like things that are doing really, really well. Things like Nu Skin and things like Polaris Industries and things that have great charts and have sort of sailed right through this mess. We're sort of staying out of the sort of mediocre value middle. And I think that's how we're approaching it. I think it's going to work. But again, it's mostly doing that because we just don't have a lot of confidence in any particular strategy in this U.S. market at the moment.
Michael, let me ask you one more question here. Leon Black was speaking today. He, of course, is head of private equity from Apollo Global Management, and he's saying he really thinks the European banks are going to have to do a fire sale at some point, and there's going to be a lot of opportunities based on those fire sales, saying that you might see real estate loans, non-performing debt, whole companies having to go up for sale. Do you see opportunity in that at this point, or do you think it's too early to look at Europe?
It's certainly too early. We're not there yet. I think we need to see a Greek default or something significant that really puts pressure on the banks to start liquidating their balance sheets and start raising capital in a significant way. When that happens, if that happens, I should say, we would expect to see some real opportunity in European markets. So whether that's in the company, whether it's in real estate or other places, I think that would be a great place to be.
All right, Michael, we got to leave it there. Do appreciate you joining us here this afternoon on Street Smart.